Good afternoon, everyone, and welcome to today's webinar. My name is Natalie Martin-Booker. I'm Certified Financial Planner with WealthPro. Today's webinar topic is how do I fund my kids' education? So this is a question that I often get asked by my clients, and I mean, it's not so much how do I fund my kids' education, because obviously you'd probably be well aware that you need to save and invest in some capacity. But I guess today is about how best to do that. What's the most efficient way? So essentially it depends on your individual circumstances, but I've got three different options to run through with you today, which will give you some ideas how it might work best for your personal circumstances. So the three different strategy ideas are: number one, do I save money in my offset account attached to my mortgage? Number two, do I invest it in a personally held investment portfolio? Number three, do I use an investment bond? So just general advice warning, this is general advice only. Obviously haven't taken into account anybody's personal circumstances for the purposes of this webinar. So, it might be a good idea to, if this is something that is a question that you're contemplating, to come and have a chat with me personally after the webinar at some point. So do I save in my offset account? So this can be a really great option if you have a mortgage, if you have good cash flow and you're saving a lot of money in your offset account with a view to paying down your home mortgage more quickly. The advantages are the cash is readily available to you, it's accessible at any time. Obviously, it saves you interest on your mortgage, which helps you repay your mortgage more quickly. There's a guaranteed investment return. So the investment return is, your mortgage rate, and as long as you're making the repayments, then that is guaranteed. Other advantages: there's no tax payable on that income that you're effectively earning, so which is really the interest that you're saving on your mortgage. The disadvantages of saving in an offset account, though, for the purposes of saving for children's education, is that the funds are not specifically earmarked for the child or for the purpose. So they're just in your sort of general cash pool, and they are there, for the purpose of repaying your mortgage, and also used for everyday, expenditure and so on and so forth. The big disadvantage of that, I guess, relates to the second point, which is that possibly you might end up with limited savings. So what I mean by that is, when it comes time to actually fund the child's education, whether it be high school or it might be university that you're thinking of this kind of strategy for, there may not actually be the level of savings there that you're hoping for. Circumstances can change, income may drop or whatever, and it may just be that when you get to that time, there's actually nothing there to provide for that purpose. The other disadvantage is that the investment return is relatively low. So you earn your mortgage rate, which is, prevailing interest rates around about 3% per annum, which is obviously quite low compared to other investment options that are available. So the second strategy that you could use is investing in a personally held investment portfolio in your own name. So it's obviously outside of superannuation. It's, you could use managed funds, you could use a share portfolio or whatever. The advantages of this strategy are, again, that the money is easily accessible. You can get at it should you need it at any time. There's no restrictions on timeframes or anything like that. There is a wide range of investment options. So you can invest in Australian shares, international shares, fixed income, within reason, anything really. There's the potential for much higher investment returns. So in a growth or a high growth sort of asset allocation, you can expect to earn around about 9.5% per annum, which is obviously a lot higher than your mortgage rate at 3%. You would benefit from dividend imputation and franking credits on Australian shares that you held personally, which obviously help with the tax effectiveness of the investment. The disadvantages of this strategy, though, is obviously with higher risk, higher return style investments, there is higher volatility, which might mean that when you need the funds at whatever point, the market may have corrected, the fund value may be lower. But with this type of investment, we would definitely recommend a long-term time frame anyway, which is generally you know, the sort of time frame you're looking at for education funding anyway, so 5 to 10 years. Major disadvantages that this type of investment cannot be held in the name of the child. And the reason for that is because, or rather it could be, but it would be subject to minor tax rates, which can be very, very high, up around the 61% mark. The other disadvantage is that any income and assessable capital gains are added to your personal income. So if you're a high income earner and you're in the highest marginal tax rate, any income or assessable capital gains from your child's education funding investment will be added to your income. The third strategy that we often use is an investment bond. So an investment bond is an investment which is essentially set up by an insurance company. It's kind of like a wrapper, and within that insurance bond or investment bond, you can invest in similar types of investments to what you can invest in outside of investment bonds, so Australian shares, managed funds, international shares, that type of thing. The main advantages of using an investment bond is that the investment can actually be held in the name of the child. So you can specifically earmark the investment bond for the particular child, and you can set up, you know, multiple different bonds for different children, that type of thing. You can set a vesting date at any age, you know, age for the child. So you could set it for 18, for university at 25. If you start there, you know, if you're wanting to fund high school, you wouldn't want to start something like this when the child is a baby, and you might want it vesting at 12 or 13 or whatever. You can also set a beneficiary in the case of death. So that can be in the case of the death of the child, but also in the case of your death, so that, you know, it doesn't kind of form as estate assets, and it can pass directly to the child in that case and continue until the vesting date. It is the most important advantage of an investment bond is that it is a tax-free structure after 10 years. So how that works, because it's actually this wrapper that I mentioned earlier that's set up by insurance companies, it's actually a tax-paid investment. So the insurance company pays tax at the 30% tax rate on all earnings within the fund. And then after 10 years, you can actually redeem that investment tax-free. So there's also no capital gains tax realised when you withdraw those funds too, which is a huge advantage, you know, if you have had good growth in that investment over that time frame. The other advantage is that you can restrict use of the funds by the child. So say you wanted to set up an investment bond for your child to use to pay for their university fees or accommodation or whatever, you can restrict the access of the funds to just that purpose. So they can't go and buy a, you know, expensive car or something like that, or go on holiday around the world or whatever. The disadvantages of this type of structure are that it is restricted access for 10 years. So you can get access to the funds, but if you do, they will be taxed. So you really, in order to gain maximum advantage, you really need to leave the funds invested for the 10 years. Further to that, there are also restricted contributions. So you are restricted to 125% of the previous year's contribution. So it's a good idea if, you know, if we recommend that you sort of set one of these up, that you make kind of regular ongoing contributions, just so that you're not restricted from making further contributions in the future. As I mentioned previously, there is a 30% flat tax rate on earnings for the first 10 years. So obviously that is an advantage if your marginal tax rate is higher than 30%, but would be a disadvantage if your marginal tax rate is lower than 30%. The other disadvantage is that, you know, by comparison with an investment just in your own name, there are somewhat limited investment options. So you're limited to, say, 50 managed funds, which is still, you know, still gives you really good scope to set up a good long-term investment. So those are the three strategies that we would generally recommend. And in terms of, by way of conclusion, so what strategy you are best to use really depends on your individual circumstances, and it depends on your individual income and marginal tax rate. So you can see in the chart here that if your tax rate is 0, so this might be in the case of a non-working partner, then a managed fund is probably the best option. Offset accounts, not a great option. The insurance bond is an okay option. If you are a high income earner and you're on the 47% marginal tax rate, then the investment bond is definitely the best option. So, in conclusion, for most tax rate, the offset account is not the best option, and that's primarily because the investment returns are a bit lower. And I think coupled with the other disadvantages that I mentioned, the fact that it's not actually earmarked for the child is probably not the best. So in conclusion, if this is an issue that you have been wondering about and that, you do want to do something about in terms of providing for your children's future education, and it may not be just education, you may want to just provide them with, sort of lump sum to set themselves up as an adult for their first home or first car or whatever it might be, then please come and chat to us and get some advice that's specific to your personal circumstances. So you can either give us a call on 1300 887 137 or email me, natalie@wealthmed.com.au. Thanks very much for your attendance today. I hope you've enjoyed the webinar and I hope that you've taken a few little tidbits out of that. Enjoy the rest of your day.